Hi guys, Sandy Ingram here from the Education Matrix channel, because education changes everything. And today I'm going to share with you a group of investors in America who legally avoid paying capital gains taxes on million-dollar properties. In the last video, and the link is, up above on the right side of this video, we talked about the Opportunity Zone funds, and that new tax law defers capital gains taxes. But this tax law, which has been in effect for decades, will absolutely wipe out capital gains taxes. And I'm going to share with you exactly how that's done. Are you ready? Let's get started. Now, what I'm speaking about is Section 1031, and there is no limit on how many times you can exchange your property for another property that is like your property, and you have to adhere to certain deadlines and pay absolutely no capital gains on the exchange. Now, if you receive money back when you exchange the property, you must pay taxes on that additional amount. But there are more rules, and I'm just going to share them with you in summary, and I will leave a link in the description to the IRS page, and you can speak with your tax professional to learn more about how to implement this and how to absolutely pay no capital gains taxes. The tax code that allows you to do this is called the Internal Revenue Code 1031. The Tax Cuts and Jobs Act, Section 1031, now applies only to exchanges of real property and not to exchanges of personal or intangible property like it did before. The properties must be like kind of properties, some of same nature or character. The properties can differ in grade or quality. This means you can trade a residential home with 3 or 4 built-in in-law units for a home on the beach, which only has 1 extra bedroom that you qualify as an in-law unit. Why would you want to make such an exchange? Well, maybe you are getting ready to retire and you'd rather not pay capital gains taxes. So you just find someone, and you usually can do that by going to a real estate agent or going online and searching, and you find this cute little house. It's definitely not comparable to your property, but it's so expensive because it's right on the beach. And this is what you want for your retirement. You can exchange with this owner, and he or she can have rental property in the city, and they're very happy with that, and you're very happy about being out on the beach. So you just make the exchange, and neither one of you pay capital gains taxes. That's what it's all about. Now, there's many reasons why people exchange their business property for another property, but I'm just giving you one example. Now, here's the important deal. There are 2 important deadlines associated with the 1031 exchange. If you miss either of these deadlines, you will owe capital gains taxes. The first deadline is 45 days from the date you sell your property to identify potential, and the IRS calls it replacement property or properties. The second deadline is you have 180 days from the date you sell your property to purchase your replacement property. So it's always a good idea to always have these, what you're going to exchange, who you're going to exchange with, already set up before you sign the papers and release your property. Now, here's the bottom line of the IRS tax code on Section 1031. In order to defer all of your capital gains taxes, the replacement property must have a purchase price and mortgage balance equal to or greater than your property. There are groups of investors in America who do this all day, every day. Thanks for listening. This is video 2 of the No Capital Gains Taxes series, and I will see you in an upcoming video. And you know the drill.